Mr. Patrick, can we start now?
Yes, we can. Yes, we can.
Okay,
Turn our
so
videos from the start, or
Pastor Akuma, are you there, please?
Yes, I'm here.
Okay, please, you can go ahead. I think you are
Good
the
afternoon.
main moderator. Yeah.
Good afternoon, everyone.
Good afternoon, Chairman.
Okay, I want to welcome everyone to this webinar. For everyone who had made out time to join this webinar. Good afternoon, distinguished directors, respected members of the Institute, our esteemed speakers, panelists, and specially invited guests. On behalf of the Executive Committee of CIoD Port Harcourt Zone, it gives me great pleasure to welcome you all to this very important and timely webinar focused on understanding the implication of the new tax law in Nigeria. At a time when regulatory changes are reshaping the business landscape, it is imperative that directors remain informed, prepared, and proactive as leaders entrusted with governance responsibilities. Our ability to understand policy changes such as this position us not only to protect our organization, but also to provide strategic direction and sustainable leadership. Today's section is particularly significant because taxation remains the critical pillar of economic development, corporate compliance, and national growth. Conversation like this creates a platform for knowledge sharing, clarity, and strategic insight necessary for effective boardroom decision making. We are indeed privileged to have such thought leaders and seasoned professionals who will help simplify and this complexity of the new tax framework and provide practical insight that we can all apply within our respective organization. It is now my distinct honor and privilege to introduce the President and Chairman of Council of the Chartered Institute of Directors Nigeria, Otumba Adetunji Oyebanji, FCIOD. Mr. Oyebanji is a highly respected, Otumba Oyebanji is a highly respected corporate leader, an accomplished boardroom professional, and a passionate advocate for good corporate governance in Nigeria. His leadership continues to strengthen the Institute's role as the foremost voice of director and governance practitioners in Nigeria. Through his stewardship, CIoD Nigeria continues to promote ethical leadership, sound governance practice, and capacity development for directors across all sectors. Sir, we deeply appreciate your continued commitment to strengthen corporate governance and for always creating platforms such as these to equip directors with knowledge required to lead effectively in the rapid changing environment. Distinguished ladies and gentlemen, please join me as I warmly welcome and invite the President and Chairman of Council, Chartered Institute of Directors, Otumba Adetunji Oyebanji, FCIOD, to kindly deliver his opening remark. Thank you, sir. Mr. President, sir.
Muted. Thank you so much. Good afternoon, distinguished ladies and gentlemen. It's an honor and privilege to be with you on this very, very important webinar. The host and acting chairman, Port Harcourt branch, Mr. Kufre Abasi Ubaha, MCIOD. Our guest speaker, Mr. Abad Folorunsho. Discussants and panelists, Mrs. Tari Boba, Mr. Henry Eberechi, Elder Vincent Okuku, and Mr. Gbenga Alaba. Members of the Governing Council of CIoD, fellows and members of CIoD Nigeria, icons and captains of industry, associates, partners, and sponsors, distinguished ladies and gentlemen. It is my great pleasure to welcome you all to this important webinar organized by the Port Harcourt branch of the Chartered Institute of Directors, Nigeria. Today's discussion is both timely and strategic, given the significant ongoing transformation in Nigeria's fiscal and tax governance landscape. This webinar provides a platform for stimulating constructive dialogue and knowledge exchange aimed at deepening our collective understanding of the new tax regime and its implications for our citizens, businesses, and the broader economy. The theme of this webinar, the new Nigeria tax law and its implications on daily life, citizens, businesses, and the economy, reflect the growing importance of understanding how fiscal reforms influence not only government revenue, but also consumption decisions, economic productivity, business competitiveness, and general welfare of the citizens. Distinguished participants, as we are all aware, the implementation of the new tax laws effective from January 1st, 2026 represents one of the most significant fiscal reform initiatives undertaken in Nigeria in recent decades. We are witnessing an overhauling of Nigeria's tax architecture and modernization of the fiscal system, with a focus on improving transparency, strengthening revenue mobilization, streamlining tax administration, enhancing digital integration, and providing clearer compliance pathways for taxpayers. An effective tax system is a critical pillar of national development. It enables governments to mobilize the resources necessary to fund infrastructure, education, healthcare, security, and other public goods essential for economic growth and social stability. Beyond revenue generation, a modern tax system must also achieve several important objectives, including the following: promote fairness and equity, ensuring that the tax burden is distributed in a way that is just and inclusive. Support business growth and investment, avoiding excessive regulatory burdens that could discourage entrepreneurship or stifle innovation. And finally, perpetuate social contract by strengthening and trust between government and the citizens, ensuring that tax revenues are utilized responsibly for the benefit of society. It is therefore important that stakeholders across the public and private sectors understand the practical implications of these new tax laws on citizens, businesses, and the government. One of the important elements of the new tax framework is the introduction of relief provisions aimed at easing the financial burden on households, particularly low and middle income earners, measures such as rent-related reliefs and the like. Also, the removal of value-added tax on certain food items are intended to cushion the cost of essential living expenses. These measures could potentially increase disposable income, especially for vulnerable households that spend a significant portion of their earnings on housing and food. For the reforms to succeed, they must not only increase revenue, but also support economic growth, encourage investment, and promote the formalization of economic activity. In other words, the tax system must strike a delicate balance, mobilizing revenue for national development while ensuring that businesses remain competitive and productive. If effectively implemented, these reforms could contribute to greater fiscal sustainability, improved economic resilience, and a more transparent and predictable business environment in Nigeria. Ultimately, the success of the new tax regime will depend on efficient implementation, institutional coordination, and continuous engagement between government, business, and citizens. I would like to commend Mr. Kufre, MCIOD, the acting chairman, the executive committee, and all members of Port Harcourt branch for organizing this important and timely engagement. This initiative demonstrates the Institute's continued commitment to promoting informed dialogue on policy issues that affect corporate governance, economic development, and the business environment in Nigeria. Most importantly, I wish to acknowledge and thank our distinguished speakers and panelists who have graciously agreed to share their expertise and perspectives on the implications of the new tax regime. I am confident that their contributions will deepen our understanding and provide valuable insights into the opportunities and challenges presented by the new tax laws. As participants, I encourage all of us to actively engage in the discussions, ask questions, and share perspectives that will help deepen the quality of this conversation and facilitate consensus. The Chartered Institute of Directors remains committed to supporting policy dialogue, strengthening corporate governance, and promoting responsible leadership in ways that contribute to sustainable economic growth and national prosperity. On this note, I have the honor to formally declare this webinar open and wish us all a very productive, enlightening, and impactful deliberation. Thank you for listening.
Thank you, sir.
Thank you, sir, President and Chairman of Council, for that wonderful opening remarks and that sets the tone for this webinar. My name is Pastor Casey Akuma, the moderator, together with the Honorary Secretary of the Port Harcourt Zone, Mr. Chukwuemeka Waneri. Two of us will be anchoring this webinar. And like the President and Chairman of Council has said the tone, we look forward to a very effective and impactful webinar. Without much ado, I'd like to welcome the speaker for this webinar with the topic, the new Nigerian tax law and its implications on daily life of citizens, businesses, and the economy. And the person to do that is no other than Dr. Henry Wofuro Eberechi. Dr. Eberechi is the Chief Executive of Elvano Energy Services and a partner with Clifford Agwe and Co-Chartered Accountants. He's auditors to several companies and clubs in Rivers State and beyond. Henry has worked with Japan Oil and Gas PLC, on Oando Energy Services, and Chevron Nigeria Limited. He's a consultant and well-grounded in accounting from BSc level even up to PhD. He's a member of Certified Public Accountants, CPA, charter member of the Charter Institute of Taxation of Nigeria, as well as the Charter Institute of Procurement and Supply, CIPS, UK. Henry has written several published articles and has presented lectures in several organizations. Some of the topics include the new tax reforms. It's my privilege and honor to welcome Dr. Henry Eberechi to take us on the new tax law and its implications on daily life of citizens, businesses, and the economy. Ladies and gentlemen, please welcome Dr. Henry Eberechi for his presentation. Doctor, you have the floor.
Yeah, I'm trying to get the shares now. But I had it before. Please, can you help me share it? Share it, the document, please.
Patrick, can you assist Dr. Eberichi to share? Okay.
Okay. Okay, thank you so much. First of all, let me appreciate the body for this invite. It's a pleasure that I will not take for granted. Thank you so much for bringing me to this unique and wonderful body for me to come and present on an issue that is making the rounds. Thank you so much. So we'll just go to the next slide, please. Okay. As a matter of fact, the new tax law, is actually on 4 cardinal areas: the Nigerian tax law, the Nigerian tax administration law, the Nigerian revenue services establishment law, and the joint revenue board establishment law. Please, next slide, please. I will, because of the time allocated to me, which is 15 minutes, I might not be able to go through the integrity of the details of all the laws, because I was restricted to a particular area, which is the one I will go and I will digress furthermore. For now, I had to state all this so that as an introduction to what I'm doing or what I'm presenting. So please, let's just go forward to the next and the next one. The next slide, please. The next slide, please. The next slide, please. The next slide. Can you hear me? Hello? Can you hear me? Please,
Yeah,
the next slide.
they can hear you.
Yes, we
Coming up.
can hear you. Please go ahead.
Next slide, please. I said next slide. Please, let me have the slide, please. The slide, please.
It's coming up, Doctor.
Okay. So let's go to the next slide. Hello? Okay. Please go back. Yes, go back. Yes, here. Please, here. Okay, thank you so much. As a matter of fact, this particular topic is not a topic that will spend 15 minutes or 20 minutes or 30 minutes. The very last engagement I had with Society of Engineers, for a 30-minute presentation, it took us more than 1 hour, because it's a contemporary issue that everyone wants to get, knowledge about. But because I've been narrowed to this particular area, I will try my best just to present it in a more or less like a question and answer angle. Then maybe the next speaker, who happens to be a senior fellow, he will have the opportunity to digress or to talk more on the particular topic. All right, the area I was actually asked to talk about is the misconception and wrong perception of the new tax law. So the Nigerian new tax law has faced significant public misconception, bank account debits, taxation of remittances, and massive new burdens on the poor. In reality, the reforms focus on taxing high, low-income earners, small businesses, and pensioners. That's in reality. But over the media and whatever we're seeing today, there are so many misconceptions, which I'll be able to bring maybe some few of them, and then we'll look at it and then tackle them one after the other. The truth is that when a change comes, it's not too easy for acceptance. So the likes of us tried our possible best to see how we can educate the masses, so that what the confusion they have will put them in the right perspective. One of them is that there will be VAT on food, healthcare, education, thereby increasing the cost of items. This is a very wrong conception. The new tax law, has removed VAT on food, removed VAT on healthcare and educational activities, education, representing about 60% of all consumptions. As a matter of fact, there will be VAT exemption on transportation, renewable energy, CNG, baby products, sanitary towels, and fuel products, representing over 20% of all consumption. These items constitute an average of 82% of household consumption and nearly 100% for low-income earners to ameliorate the rising costs of living for workers. Next slide. The next misconception is government will automatically debit bank accounts. This is another wrong misconception. The new law does not allow automatic debits, direct debits. Banks must report. Tax is based on official assessments, not on inflows. So your taxes are on your assessments. The misconception about debit bank accounts, so they automatically, taxed. That is one very high misconception that needs to be corrected. The next one is pensioners. Pensioners and retired individuals will pay more taxes. Again, another misconception. Pensions under the Pension Reforms Act, alongside specific retirement benefits and severance packages for job losses, are explicitly exempted. Military salaries will be taxed for that misconception. The salaries of military officers are now tax exempted. So those items will not be taxed. The fifth one is the tax authorities can seize assets without legal approval. Another misconception. The law strengthens protection for taxpayers, requiring proper legal procedures, including court approval for the seal of assets, rather than allowing direct unilateral seizures. So this is another aspect that we need to correct, and we're trying to correct it. Number 6, say every bank transfers or POS transactions is taxed. Another misconception. Tax is determined by taxable income, not the total volume of personal transfers. Gifts or bank transfers, those are not taxable. Every small business is taxed. Small businesses with a turnover of up to 50 million annually are exempted to be tax regulation. There's an increased threshold from 20% to 25 million naira to 50 million naira to enable small firms to grow into larger scales. So you can see that this new tax is even beneficial to small companies. Before now, taxes like company income tax, education tax are taxed on small companies of 25 million and above. But currently, that is totally exempted. The threshold now has increased to 50 million, which gives the small businesses an advantage to grow and have more disposable income to do many other things and expand their business. The next one is the new Nigerian tax law will take effect in 2027. This was in the media for a while because of maybe one of our highly placed politician that was saying that new tax will start in 2027 and all the rest. That's also is a misconception. The new tax law has already started. It started existing. In fact, two of them started 6 months even before 2026. And then the effectively started in January 2026. As a matter of fact, one of the proof to show that this is effective is the name FIROS having changed to NROS. That shows that it has already started. The new number 9 say I just itemized them into numbers. The new tax law are for poor individuals. Again, it appears to all individuals that it applies to all individuals that in income in Nigeria. Workers, content creators, remote workers, influencers, traders, etc. And to Nigerians earning income abroad if they are tax residents in Nigeria. If they are tax residents in Nigeria. Now you can see that the new tax law is actually skewed towards the poor and not even to the rich. Number 10, transfers and deposits into the bank account is to be taxed. Moving money, the answer is moving money around via POS, transfers, deposits, or withdrawals is not a taxable event. What is tax is what? Income earned. And in income earned, you also have to declare your income. And the taxable income is what is going to be taxed at the end of the period. Number 11, money kept in my account will be taxed from 2026. Again, another misconception. Just having money in your account is not taxable. Only the income you earn, like salary, business profits, or interest, is what can be taxed. For salaries, of course, you pay PAYE. Then for the business profits, you pay company income tax. And then currently, the development tax we pay now, no longer even the education tax, because most of the taxes have been what? Have been merged together. Thank you. Next slide, please. Students with no job will pay tax in 2026. The answer is, if you have no taxable income, you won't pay tax, whether you're a student, and whether the students are schooling and all the rest. I mean, you don't have any income, so why will it be taxed? So the new tax law has exempted students that are not earning income. Loans borrowed from Fair Money or any lender will be taxed. Loans are not taxable, given that they are not income. However, the interest income earned by Fair Money will be taxed at their own end. Thank you. Next slide. Next slide. Next slide. Okay. Say tax. The next one. Go back, please. Go back. Go back, please. Okay. Say tax will be paid on, no, the next one, please. Okay. Say tax will be paid on profit made from shares sold in 2026. As long as the shares you sold are not more than 150 million in value, and the gain is not above 10 million. However, if it is higher than this threshold, the gain becomes taxable. Pension income will be taxed in 2026. The answer is approved pension and retirement benefits are exempt from tax. Next slide, please. Okay. So pension income, personal income tax will be more taxed in 2026. On the other hand, they tax the poor. The answer. Individuals earning the national minimum wage or less, and those earning below 800,000 naira annually are exempt. You can see the breakdown progressively on how taxes are being made. What this simply means is that, like I said earlier, the tax is actually skewed to favor the poor. The minimum national minimum wage, they are not taxed. If your income is about 800,000 naira annually, it's a zero payment. Then see the progression from 2.2, 15%, 9 million, 18%, 13 million, 21%, and so forth and so on. This can further be broken down if the accountants are engaged in the company to help them out. Now, comparatively, between this and the previous breakdown, you find out that you'll be paying lesser than what you usually pay before. And that is how it is. So it is better to even favor us to undo the Nigerians. Calculating payee, this is the calculation again to further calculation of the payee. Some of us might not be able to get this accurately, but when an accountant is engaged, the accountant to do a proper calculation on how it is supposed to be. But with this simple analogy to show us here that what we're supposed to be paying now will be far less than what we are paying after 2025. Thank you. Next slide, please. Okay, several packages when leaving job will be taxed. You won't pay tax if it is 50 million or less. But if it is more than the extra amount, will be taxed. If you want an extra amount to be taxed, using the progressive tax band in number 18 above. Dividends or rent from abroad will be taxed in Nigeria. Dividends, interest, rent, royalties earned from outside Nigeria are exempt from tax, provided they are brought into Nigeria through approved channels like the finance homes, the banks, the finance homes that are approved channels for it to come in. Next slide, please. New agricultural companies include livestock, forestry, dairy, cocoa processing will enjoy a 5-year tax holiday from the date they begin operation. Income from federal or state government bonds will be taxed. No, all government bonds are exempt from tax. Next slide, 2026. Because surcharge on fuel was already introduced even before now. It was introduced in 2007, but was not implemented simply because of what? Fuel subsidy. So people are thinking because they have removed fuel subsidy now, it is now that the surcharge is being introduced. No, it has been there, ab initio from 2007. It was not introduced in these new tax reforms. But again, there's that have stated once it's improved by 5%, then we can start seeing it play out. Next slide. The government will charge 25% on sales or turnover, thereby reducing profits of company. This is not true. CIT of 25% was reduced from 30% to 25% in 2006, and is on taxable income after all expenses are deducted, not on turnover. So anyone that is spreading the news that 5% is going to be tax on sales or on turnover. That is a wrong, wrong information being spread to the public. The primary goal of these reforms is to foster efficient administration, enhance tax compensation, coherent framework. As a matter of fact, the new tax law is skewed towards assisting the low income, both in personal and in company. So that's basically zero VAT on food, healthcare, and education, representing about 60%. I've said this before now, so I think we should just go to the next one. Company income tax will turn over 50 million. All this I've stated before. But next slide, please. Thank you so much. I believe that with these few words, there are so many of them that we're trying to correct and trying to spread out to the world, that what they are thinking. The thing is that most people, particularly, I will use the word, the politicians, they want to use, they try to use propaganda to distract or spoil, good works when good works have been stated. If I took this particular new tax reforms is actually in to help Nigerians, to help the small scale industries, to grow into large scales, and then, medium and large scale. So if we comply to what is ongoing, which is already in existence anyway, because there's nothing we can do right now, we just have to comply with it and then flow with the system, do the right thing, get your books correctly, do the right accounting process, do the right reporting, and at the end of the day, you have less, taxes to pay, as long as your reporting system is done and done accurately. If you have challenges on any way for reporting, we have accountants all over the country that can help you to keep your records clean and straight. Once that is done, I bet you your taxes will be, far lower than what you used to think before or what you used to spend. And then at the end of the day, you'll be happy that you're doing business in Nigeria. Thank you so much, and God bless you.
Okay, thank you, Mr. Thank you, Dr. Henry. Pastor Akuma, can I go on?
Go ahead, Mr.
Okay, thank you. Thank you so much, Dr. Henry. Thank you. The time was actually very short. There's no way you can say everything that the tax reform entails within the very short time. Thank you for the answers to the questions you gave. So it's my pleasure to call on our guest speaker, Mr. Albert Folorunsho, for his own paper presentation. Mr. Albert Folorunsho, FCA, FCITN, FCIID, is a managing partner of managing consultant of Presto Pedapro, and also a member of the Presidential Committee on Fiscal Policy and Tax Reforms. Is part of the people that presented the paper and recommendation of the tax reform. I don't know if but I would like us to welcome Mr. Albert Folorunsho for his paper presentation. He will be looking at his paper from the government's angle. What's the objective? What does the government have in mind? Why the tax reform? Thank you. Let's welcome Mr. Folorunsho.
Thank you very much. I hope you can hear me. Just please confirm so that I can proceed.
Yes, we can hear you.
Okay, all right. So
Yes.
I'm also sharing my slide from here. And so let me stand on the already established protocol. I'm looking at the times allotted and I'm like, okay, maybe it will be enough to just cover the heading alone.
I'm sure you do your best, sir.
Yes, I'll definitely do my best. Just some quick correction I'm seeing here. I don't know why it's not saving. Okay, so thank you for inviting me to make this presentation. It was actually supposed to be Taiwo Oyedele, but I mean, you now have a higher call, and I'm just standing in for him to make this presentation. Okay, the topic, as already seen on the slide, is its implication on daily life, citizens, businesses, and economy. So it is virtually asking for everything. And I was like, okay, we want to know everything about this tax law. So I've put together a very comprehensive presentation, which we can share with others at the end of the day, and then they can dive into it. But as much as possible, I understand I have like 20 minutes as a minimum. So let me see what I can do in 20 minutes, and then if I need to add more, maybe I'll be permitted. But generally, as already enumerated by the president of the Chartered Institute of Directors, the essence of this law is not only for revenue generation, but of course, we should remember that any tax law is focused on revenue generation, but that is not the only focus in this instance. Is to streamline and to make our law fairer, more equitable and progressive, as we have seen and also mentioned by the last speaker. You know, I picked a few points that he has also mentioned, some of which I will also like the issue around small business. It remains 100 million and not 50 million. Okay, somebody has also asked that question on the platform, which I answered. And of course, when you talk about military officers, the exemption is only limited to other ranks, what we call the recruits, and those in combatant zones. Okay. Moving forward, we can see that, do you know that what has been done is to replace all the 11 legacy taxes with just one law in one swap, okay? That is just a teaser, number one for us. And again, what if your first 800 of income is now completely tax-free? We have always had something that is even more than that. But the bottom line is that regardless of your level of income, the first 800,000 is tax exempt when we are talking about taxable income. All right, so which means by the time you look at the tax table as an individual, you will be able to ascertain the likely tax you are supposed to pay. All right, so again, what are people seeing? That is why we have so many misconceptions as enumerated by the last speaker. But what people are really seeing is the fact that VAT still remains 7.5%. We'll talk about the implication of that. We have a new personal income tax band, as already mentioned by the last speaker. The first 800 at 0%, the next 2.2 at 15, the next 9 at 18, the next 13 at, those rates, we'll see them there. And the highest band rate now is 25%. Okay, so that is what most people are seeing. And the fact that we now know that FRS has been renamed as NRS, but it is much more than that. Okay, what we have is that 11 legacy laws has been repealed and consolidated into a single one. It's not a retooling, it's just a complete fiscal reset. Okay, there's the story around, not story, there's a provision relating to what we call the 15% global minimum tax. Okay, I will probably explain that as little as time will permit. And then, of course, we have the 30% EBITDA thin capitalization cap. Some provisions or laws that are prevalent in other climes have been imported so that we can have a fair taxation of the multinationals, okay, to reduce base erosion and profit shifting into different parts. There's a story around the 5% fossil fuel surcharge. Of course, we know that that will not take effect except the NEC, approved that. We have the 4% consolidated development levy replacing the XY tax fund, NASENI, and NISDA taxation. Most pronounced now is the issue around fiscalization mandates, okay, real-time digital VAT monitoring, where companies are expected to issue VAT invoice, or what we call the e-invoice. E-invoice, both by the buyer and the seller, at the end of the day, it gives the government a loop into your daily transactions. And even before you submit your audited financial statement going forward, the tax authority may already have details of what your turnover is. And so there's a lot of monitoring and cross-referencing and looping that we expect will be implemented when all of these are tidied up as we proceed with the implementation. The tax on board is something that we're hearing for the first time in Nigeria, even though they don't have too much of force but they're there to, mediate between the tax authority and the taxpayer, mostly going to be favoring the taxpayer. And we expect that those are for small and medium scale taxpayer who probably will not be able to finance or proceed to proper court. They can still use the tax ombud. Even if you have issues around custom, issues around anything that has to do with collection of tax, okay? Then we have the Economic Development Incentive Certificate, which now replaces what we call the Pioneer. Okay, I believe we are familiar with some of these things. And this is just to give us a heads up of what we have in the law and some of which we are going to drill down into to be able to understand what lies beneath the new tax law and how it affects both individuals, businesses, and the economy in totality. All right, so this is the agenda. The legislative Big Bang is what everybody is talking about today. What was repealed, what's replaced, what was repealed, how has the new tax law architecture look, the unified code structure of the 9th chapter provision, the CIT rate, and of course the METR there is minimum effective tax rate, and the development levy, the new tax band, which we have seen, the VAT framework, the 7.5, the zero rating, the exemption, and of course, the digital mandate. Digital mandate has to do with the e-invoicing, which in the first instance is compulsory for every businesses with not less than 5 billion in turnover. Okay, and it will become effective for all companies come 2028. All right, so and it's around the corner. Stamp duties has been streamlined and tidied up. We'll look at what is there. Capital gains tax, more or less, has been removed and now subsumed or streamlined with income tax. And that is why there is so much controversy in the capital market because, one, people have not been paying the CGT that was even applicable on shares. And now that they feel that it is likely that they may have to pay. And that is why there's so much fuse in terms of the impact on the market. And there was this argument, there was this complaint that foreign portfolio investors were withdrawing their investment. Yes, it's not impossible at that time. But of course, when you realize the provisions embedded in the law, you know that it is not supposed to be like that. Okay, we'll look at a few of these and then I will zero in on the impact on citizens, businesses, and economy. I mean, the real world implication across all sectors. And then what do you need to do? Your compliance action plan. You don't just wait for the tax authority to start slamming you with penalty and interest. What do you need to do? Okay, so we'll be looking at the 6 strategic steps to navigate the transition from the old law to this new law. And of course, what comes next. And we'll take questions. All right. I'm assuming everyone can hear me, so I just want to be...
Yes, we can hear you. Continue.
Thank you very much. Yeah. Okay, so these are the legacy taxes that were, restructured and subsumed into the 4 buckets that we now have. We used to have all of this. I don't think I should go through them. Let me go straight to what is new. Okay. These are the new law, the Nigerian Tax Act, which is the substantive law, that covers the fiscal aspect of the taxation itself and covers everything that has to do with company income taxation, persons or personal income taxation. The capital gains tax is now more or less under income tax. Value-added tax, these are transaction taxes. Withholding tax is source deduction obligation. Stamp duties is tax you pay on instrument or document so that you can give it a legal backing, so that it can be given in evidence if there is any dispute. Okay, and we have the petroleum profit tax, hydrocarbon tax, the royalty, the development levy, the fossil fuel, and so many things all under the Nigerian Tax Act. While the administrative aspect is covered by the NTA, okay, the Nigerian Tax Act, okay, talking about filing, obtaining your TIN, your filing date, enforcement, audit, payment type, rulings, fiscalization, sharing, how do you share the VAT, which we are all familiar with. And of course, we have the new provision relating to the Nigerian Revenue Service, okay? And of course, the Joint Revenue Board, which is significant because that is the one that coordinates all of the tax authorities, both the Nigerian Revenue Service and the individual state internal revenue service, as well as coordination and harmonization of those provisions that have been made by each of the states. We are aware that more than 12 states have already harmonized. And somebody was asking me yesterday, what do you mean by this harmonization? Okay, it has to do with the fact that most of the laws that were passed by the National Assembly, are for general application. Some of them, the National Assembly cannot make some of those provisions relating to the subnationals. Remember the exclusive, the concurrent, and the residual. Exclusive, when you say exclusive, I'm sure we are familiar with that. Those that can be made by the National Assembly, concurrent both by the National Assembly and the state, and the residuals are the ones that are not in between the two. And so those ones are left for the subnational. So some of the provisions that are required to remove or to streamline all of these nuisance taxes that are concerned for majority of Nigerians can only be legislated upon by the state assembly. And that is where the harmonization is coming in. The Joint Revenue Board is the one coordinating and ensuring that each state, make their own pronouncement, okay, in terms of legislation to domesticate what the National Assembly has passed, particularly when it comes to all of the unlimited nuisance taxes that are concerned for Nigerians. And so all of those are now being streamlined so that whatever is applicable in Lagos, we also see it in Kano. When you pay for vehicle particular in Lagos, you don't have to, when you travel to Kano, nobody should be asking you all of those sticker issues, are being streamlined. That is what those harmonization has to do with. I'm sure there are a lot of questions that people have been asking in respect of that. All right. Okay, so these are the provisions of the law. The income that are taxable, whether it's under company or petroleum, the issue relating to double taxation, that is where a person that is resident in Nigeria, derived income from outside Nigeria, in order to avoid double taxation. There are provisions to cover that. The issue of stamp duties. I've mentioned most of these, so let me rush because I'm looking at my time. But we can always take questions in any specific area, that is of significant concern. Okay, so the rate architecture is what we can see. For small company, like I said, small company is the threshold is 100 million and below, or with a fixed asset of not more than 250 million. What that means is that you can have a turnover of 0, but if you have an asset that is 250 million, that is above 250 million, you will not be classed as small company. We have some oil companies that spend billions before they even have turnover. Okay, and we cannot be referring to such company as small. So the threshold is determined by either your turnover or the asset base. Okay, and like I said, in terms of turnover, it remains 100 million. And the tax rate still is 30%, but it is hopeful and provided in the law that it could be reduced to 25%. And we're hoping that that will be done before the end of this year, before the law actually take effect on the 2026 transactions, okay? By the ruling of recent cases, ordinarily, when it comes to income tax, the applicable rate is the one that is existing at the end of the financial year of that company. And if you are a company with a financial year end of 31st of December, 2025, the NTA will not apply to you. Okay, by the ruling of the court, I know that the FRS is hopeful that they can apply the NTA on your 2025 account. For a number of clients that we represent, it is very clear that that should not be. Okay, then we're looking at that 15% rate. The 15% rate is now the minimum effective tax rate for multinationals. As long as you're a multinational company, with a group turnover of not less than 750 million euros. Under the OECD inclusive framework, the requirement is that any member of that multinational group, either as a head office in Nigeria or a subsidiary in Nigeria, the entity must be tested for this 15% minimum tax. The additional burden is the fact that even if you are not a member of a multinational group, but you have a turnover that is above 50 billion in a year, all right, and you are a Nigerian company, you will be required to pay the minimum tax or minimum effective rates of 15%. I will explain how that works as briefly as possible within the time limited. I'm just worried. Okay, so we have the development levy, we have the minimum effective tax, and we have this thin capitalization. Thin capitalization has to do with allowing intercompany loans interest. The question is, how much deduction is allowed when you borrow money from your related entity? There is a cap, and the interest must not be more than 30% of your EBITDA. Any before interest tax, depreciation and amortization. Okay, there are some detailed provision which you can ask questions if you require, as it will take me time to go into some of these details. But I'm trying to rush to address the main issues of this presentation. Okay, so speaking to the global minimum tax, which I believe directors on this call should be very conversant, because it's a major thing that one must take particular interest in, particularly if you work for a multinational or you work for a company. There are several companies that are caught by this provision. Most companies have turnover more than 50 billion anyway. And so we all need to understand this. So how do we calculate the 15% global minimum tax effective rate? First, you need to calculate the normal tax that every company is liable to pay, and we call it the cover taxes. Okay, you can see under cover taxes, I put CIT, PPT, hydrocarbon tax. That does not mean that a company can be liable to CIT and PPT at the same time. All right, I'm saying that if you are a sister company you pay CIT, but you have to pay development levy as well, or priority sector credit if you are a PPT company. So the first three items cannot be applicable to the same company at the same time. So, but that is the covered tax. Even capital gains tax can come into that role. Then you also determine your net income. Your net income is your profit before tax, with small adjustment as mentioned, which is frank investment income. Frank investment income is dividend. We're saying dividend is not exempt because it's already suffered tax anyway. Anybody receiving dividend as an income, 10% will have been deducted. And the law says that when you deduct withholding tax of 10% from dividend, it is taken as final. That does not mean it's an exempt income. So we're just taking it out because it has been taxed anyway at the rate of 10%. Okay, so when you do adjust a small adjustment to your profit before tax, that forms the base for determining your effective rate of tax, and you divide your covered taxes by by that base. It gives you your effective rate, and you check if that rate is less than 15%, then you need to pay what is called a top-up tax. It's a bit complex, but I'm sure we will find a way to get into details if it is applicable to us. You can see the last line there. I've tried to speak to the free zone entities, those companies that are operating in the export free zone, okay? How it impacts on them. That is also another concern that if it is applicable to you, you need to seek for understanding. Yeah, going back to the personal income tax that my brother already explained earlier, the new band. And so I'm saying here that the 800,000, let's understand that clearly again, is not your income. 800,000 is your taxable income. All right? When you say taxable income, it means you have an income from which you are eligible to take some deduction. Deduction like your pension contribution. If you claim the rent relief, there's this 500,000 rent relief. I'm sure we are familiar with it. If you are ready to fight with your landlord, why not? Rent relief, your NHF, your mortgage interest. If you are taking a loan to build your own personal house where you want to live, you take all of those out of your income before you arrive at what is called the taxable income. And that is what we mean by the 800. The 800, so which means if you have an income of 1.2, at the end of the day, after taking some deduction, it may be 850. So it is that 850 that is the taxable income. So we're saying that when you get to taxable income, the first 800 is to be taxed at 0%. And in fact, law also, that was trying to mirror or align with the minimum wage threshold, okay? And so the first 800 is exempt, the next 2.2 at 15%, the next 9 million at 18%. And, you know, the last column there, I was trying to compare that with what we currently, not currently, because we're in 2026, this new law have started, what we used to have in 2025, okay? You see that the 2.2 used to be at the rate of 21%, but it's now at 15%, because by the time you get to 2.2, under the old law, you're already at the threshold of 21%. Okay, so the summary of this table is that if you earn not more than 1.2 million, or yes, if you earn like 25 million a year, your tax will reduce under the new law. But if you earn above 25 million a year, definitely your tax is on the rise. And that is just the summary. We'll take our time and look at it at our good time. Okay, so this is VAT. VAT remains at 7.5%, and that is now already a challenge to government. Why? Because we have changed our VAT to proper VAT. It used to look like something that is more or less a sales tax, okay? But it is now VAT proper, which means when you have output VAT, you deduct your input VAT. Input VAT is the VAT you pay when you are buying items for the sale, or when you are paying for services, or when you are buying assets and they charge you, you pay. That is input VAT. Whatever you use all of those assets to generate is your output, And when you ask people to pay you, whatever they pay you and you add VAT to it, the VAT element you add to it is the output VAT. What is due to government is the difference between your output VAT and your input VAT. And so, under the new law, the input VAT base has been expanded, okay? It used to be only goods purchased for resale or goods manufactured for resale. That has been expanded to include goods purchased for resale, one, the VAT you pay on your asset that you are using to generate the output, and the overhead expenses, excluding salaries. Your overhead expenses, you also pay VAT. If you hire a professional, you pay VAT to on the invoice issued. The law says all of those inputs are deductible. And so if you are deducting all input from output without increasing the rate, government is out of pocket. And they already seen the impact in collection between February and now. Okay, but that is for us to enjoy for now before the government will come forward to give reasons why the VAT rate should go up. Because to really make sense to government to give all of those inputs as a deduction, the rate should not be less than maybe 12.5% to properly break even. But we also know that in the neighborhood of where we operate in West Africa and other countries in Africa, the rate is around 20, not less, shouldn't be less than 15. But for now, because government, this is sensitive time, they don't have the courage to increase this VAT, but that is what we have. In addition to that, you can see that there are two items which was mentioned by the earlier speaker. I have presented some of them here for us to see, which is the zero-rated supplies, items that are taxed at 0%, and those that are purely, totally exempt. Okay? It looks like zero-rated is better than exempt, which means when your output VAT is 0 and you have something that you have paid as input VAT, it means that your input will always be higher than your output. Where your input is more than your output, you are entitled to a refund from the tax authority. Okay? And so that is the implication of zero rating. And exemption means that you are not even expected to charge VAT at all. Just go away. If you pay VAT anywhere, it's your business, but don't charge VAT. I've had a team of companies saying that they prefer this exemption. And by the time they gave their reasons, I almost supported them. Because for zero rating, you are going to be making a claim for refund. And we know how difficult to get refund. So they would rather just get the exemption, their input VAT, the expense it. If it is overhead, the one that relates to their assets, they capitalize it. They say life is easy. Leave me in exemption. I don't like this zero rating that makes me to go to tax authority and be begging them to give me refund of my VAT refund on what I paid. Yeah, so but that is the implication. That is the difference between zero rating and exemption. I'm trying to be faster now. Okay, so other things that have come up with this new law is the issue around fiscalization. Fiscalization related to e-invoicing majorly. As you are buying and selling, there's a platform that FRS now, NRS had, which they still have, okay, such that your real-time transactions are being captured by the tax authority. Okay, and so particularly when it comes to fiscalization, we want to be able to know where items are being consumed, particularly for VAT sharing at the end of the day. Okay, that is why the fiscalization is very crucial, and it can only be done through technology, deployment of physical electronic deployment of electronic physical instrument to be able to do this. All right. There is also the provision relating to non-resident for VAT. Yeah, that is what is obtainable in so many places. There is the self-accounting where the tax authority can request that you deduct VAT and not pay. For example, all banks now, any business you do with banks, for example, as a consultant to banks, if I issue them an invoice, instead of paying me my money plus VAT so that I can remit, government has already given them mandate to deduct the VAT, okay? And all of those are things that we need to watch out for as directors non-resident VAT, input VAT credit, and all that. Then we have the modernization of some transactions, the stamp duties. Some of them are exempt. All these 50 naira that are being charged, okay, that people think that government has introduced new tax. And it is not. It is the same 50 naira, which means for every transfer that is above 10,000 naira, and it is not from you to you, okay? Because if you are transferring money from one account to another, there can be dispute. We need to have an understanding of what that 50 naira they are charging us is all about. It is because it is possible to have a dispute if you instruct your bank to do a transfer. And if there is any dispute, okay, it can result into legal contention. And where that happens, any instrument that is not fully duted, or you have not paid duty on, you may not be able to present it as an evidence except criminal issues are involved. All right, so that is why we actually pay stamp duty. But on top of that, government also want to collect revenue. So we have a long list of transactions that are exempt and a long list of transactions that are taxable, including rent. The way to understand stamp duty is to think in this manner. Anything that is exempt from VAT may likely be liable to stamp duty. And anything that you pay stamp duties on is not likely. I'm not saying categorical that is correct, but it's not likely to be liable to VAT. For example, rent. Rent is not liable to VAT, but you pay stamp duty. Agreement on purchase of property or land is not liable to VAT, but the stamp duty. When you give out loan agreement, there's no VAT on taking loan, but you pay stamp duty. So it's a mirror of each other. By the time you are paying stamp duty and VAT on the same transaction, then there's a problem. Again, we come to capital gain. Capital gain now, what has changed as far as capital gain is concerned is the fact that it is no longer capital gains tax with a specific rate of 10% that we used to have. Okay, so the rate now depends on who has earned the gain. Is it a company or an individual? If an individual has generated a gain from sale of shares, from sale of property, sale of land, sale of vehicle, blah, 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 as the case may be, it is that individual that will take it as part of an income, which will climb that tax table that we saw earlier. First 800 will remain 0%. The next 2.2, 15%. The next 9 million, 18%. The next 13 million, 21%, and so on. But if it is a company that is generating this gain or income now that we call it, including if you sell shares in the capital market and you make massive gain, particularly where the proceeds of sale is not less than 150 million in a 12 period cumulatively, or where the gain you made is not less than 10 million, whatever you make will now be liable to income tax, which is 30%, unfortunately. So that is where the issue is coming from. The fact that the rate used to be 10, but it is now added to income and be subjected to tax at 30%. That is really the issue. But if you remember, when we talk about base erosion and profit shifting, because non-residents are also playing in the capital market, are also playing in the property market in Nigeria, when you allow them to sell and make this type of gain and pay 10%, the difference between the 10% they pay and their own effective tax rate in their own country under the OECD inclusive framework, they will pay the different tax in their country. That is the challenge. And the provision has been made such that this income was generated in Nigeria. Let us collect tax. When it comes to taxation and it relates to cross-border, the rule is that the income should be taxed at the source before the person place of residence begin to look at that income, which means if I'm resident in Nigeria, but I have an income that I generate from UK, we want to collect the tax first before Nigeria will start saying, oh, you are living here, you made one income. I say, yes, but where I made the income, they have deducted so much tax. Therefore, give me credit. And that is where double taxation issue comes in. All right? So capital gain remains controversial. Not controversial, it's just that people are not used to paying this CGT only people that pay CGT, particularly individual, is where you buy property and you want to go and perfect, probably with Lagos State or the land authority, and they are saying, okay, oh, you want to perfect this property, where is the buyer? You don't want to disclose the buyer, Lagos State will charge you something. It used to be 20% of the value or something. All right. I know they will still design something around that. Otherwise, people may run away with when they sell land, they will not disclose. If you go and perfect, you are the one looking for trouble. But again, a new rule is in the new law. You cannot just sell a company to another person that owns a property and say that you have only sold a company, where the underlying assets of that company is a property that is situated in Nigeria. The gain on that property will be liable to tax. Okay, I hope we got that. A lot of people buy property in the name of company so that when they are selling, they don't need to go to Lagos State to do perfection. They will just go and change the ownership of the company as CAC. That is no longer a tax planning opportunity. That has been removed. The underlying asset of the company will be reviewed and ascertain whether there's gain. Okay, that is just the summary of it. Let me move on. Then withholding tax has been streamlined. The regulation that we had in 2025 has been incorporated into the new law, and a lot of things has been done very well as far as withholding tax is concerned. I will speak to some more few items as we go along. Please remind me if I'm taking too much time and let me know when. I can't even round up now, sorry. Okay, so let me be faster.
Just be faster. We're enjoying it. The time is going, but just be faster.
Let me try and be faster.
Mm-hmm.
Yeah. Okay, so this is the withholding tax regime that we have. I've decided to just pick a few items and speak to them. Dividend, like I earlier said, the withholding tax on it is final. So don't say with dividend is not liable to tax. It has already been taxed, 10%. It's not small tax. All right. Interest. So what I want to mention on this interest is the fact that the law says for individuals, interest on short-term security. So your fixed deposit is also a short-term security if it is not more than 1 year. Your bank balance is a short-term security. Therefore, as an individual, if you earn interest and withholding tax has been deducted, okay, technically that withholding tax is final. That is for individual. For company, it is not. The dividend, the interest, not dividend, the interest will still be taken as part of your income. All right, and then you pay tax, and then you can claim credit for whatever withholding tax you have suffered that the bank deducted as source. Okay, so in summary, on this slide, you must do your full remit. Any amount that you don't remit, you have to pay it. In addition, you pay 10% administrative penalty, and if you are deducted and you fail to remit, you pay interest. The interest is the CBN monetary rate plus 5% sometimes, and it could lead to criminal, could lead to imprisonment. All right, so those are the things I can quickly do on this. Let me move on quickly. Yes, I also mentioned this, which is the issue around the 5% fossil fuel surcharge, which surfaces in this new law. The good thing is that this can only become effective if it is triggered by a ministerial gazette issued by NEC and approved by NEC. So for now, that 5%, nobody's applying it. It cannot be applied until an executive order is issued to trigger it. So we close it for now. The next one is the petroleum fiscal regime. Nothing really changed under PPT because, the PIA just came. We didn't want to, start doing a lot of things around. Let the PIA even settle down a little bit. Now, the last one here we're looking at is the Economic Development Incentive Certificate, which is the one that has come to replace what everybody knows as pioneer legislation. The pioneer legislation comes with a lot of benefits. That benefits, I can tell you for free here, it has been streamlined, which means you still calculate your normal tax even as a as a priority sector company, you calculate your normal tax, arrive at the tax liability. Now, instead of paying that tax liability, we will now look at how much have you invested in this economic development, in this priority sector. Whatever you have invested in year one, you get 5% as credit. That 5% credit is what you will use to offset your tax liability that has been computed. If you can offset it fully, then there's nothing to pay. If you offset it and you still have balance out of that 5%, you can carry it forward. You go to year two. Did you invest any asset? If yes, another 5%. The one you invested in year one, you still get another 5% in year two on the one you invested in year one, and so on for 5 years. The laws also say that if you are a priority sector company that is enjoying economic development tax incentive and you do not pay dividend during the priority sector, which is 5 years, you will get another 5 years. So automatically it can be as long as 10 years. Okay? But bottom line, a lot of things, but into the details of it is not as attractive as we used to enjoy under Pioneer. Because under this, your assets, you claim your capital allowance. Under the old Pioneer, you don't start claiming until after the Pioneer period. Okay? And XYZ. Dividend under the old Pioneer is not liable to withholding tax at all. Here, because of this global tax that we are being wary about so that we don't lose money to other countries, they're saying that you must pay, withholding tax is now applicable on dividend payable or paid out by priority sector companies. And you don't enjoy this incentive forever. There is now sunset. So if you say power, after some years, we have number of years to which those incentives are available has been put for the next 20 years. After 20 years, no more incentive, just like we have now. Telecom don't enjoy this incentive any longer. Okay? Sorry, let me just. Okay. Okay, so talking about how the reform affects persons on the streets, I just try to put out something which we should be familiar with by now. Low tax for low earners. Minimum wage earners are exempt. Several lists of daily needs are now VAT exempt. Potential energy cost impact, the 5%, you know, we have, but let's not talk about it because it's not yet implementable. Then there is the zero-rated essential items, which is what people should enjoy. The tax ombud protection, like I said, under the Nigerian Joint Revenue Board Act, there's the tax ombud that can liaise or be a mediator between the tax authority and the taxpayer. For small cases, that don't need you going to court or serious matter. And of course, the pass-through effect of the 4%, the 15%, not all of these effects are, you know, at the end of the day, it will still affect companies. By the time you are paying global minimum tax, you find a way to recover it and all that. So those are the implications on people on the streets. Okay. I'm sorry now. Okay, so the small and medium scale equation, relief on one hand and compliance challenge on the other side. I just try to quickly bring out things that we need to be watchful about. Is 0% CIT for small company? Yes. Increase in threshold for small companies from 25 to 100, like I said. Exempt, they are also exempt from the 4% development levy. Remember, the 4% development levy replaced what we used to have as education tax, NASENI, IT levy, and police whatever. All right, so that is, but small companies are not liable. Small companies are also exempt from this 15% global minimum tax, reduced tax for low income earners, including what was mentioned earlier by the earlier speaker, zero rating for most of the basic input items. The economic development incentive are also applicable to some priority sector companies. Okay, but the challenges remain for even the small company. This fiscalization mandate applies to all taxable persons with turnover of For now, 5 billion and above, but by upper year I mean 28, it will be compulsory for everybody to do fiscalization. And that fiscalization is what we mean by the electronic invoicing requirement, even for tech investment. Okay, the self-charge is a burden. Record-keeping requirement is stringent. Transfer pricing for related person transactions are things that small companies have to be careful about and is prevalent. And then, of course, family companies of no more than 5 shareholders, there's a provision there, so you have to be careful, particularly when you fail to declare dividend. The tax authority can declare dividend on your behalf, and what you need to do to them is pay them withholding tax. Okay? The requirement for disclosure of tax planning. Any tax planning you are doing now, if you don't disclose to tax authority, they can reverse it. So you must get an advance ruling, more or less, for any tax planning process. Okay? The exposure to minimum tax effective rates, effective tax is also something that of concern. Transition from old regime requires careful planning, a lot of careful planning, which is usually going to be challenged for small companies. All right. So some of the things that are of serious issue or concern is the Pillar 2 minimum effective tax rate, which I've explained already, the thin capitalization in terms of intercompany borrowing, the transfer pricing issue, which has to do with benchmarking. When you do transaction between related entity, the law is always very angry because they assume that whatever you are doing, if you are related, will not be at arm's length, which means it is not based on full commercial transaction. Therefore, they will want to see evidence of persons dealing in similar transactions that are not related to be sure that what you are doing with among yourself as related entity aligns with those who are not related but are dealing in similar transaction. Okay, we call it COP, comparable uncontrolled price method. Okay, we don't need to go into those technicalities. Anti-avoidance provision, I mean, anything that is too aggressive. You know, the general understanding of people is that tax avoidance is legal. It is evasion that is criminal, blah, blah, blah. There's some level of avoidance now that are seen or are classed as being a criminal and may be reversed. And that is why they are requesting that for any tax planning arrangement that you are going into, you need to carry the tax authority along. They may have to approve some of them in advance. Free trade zone, if I can just speak to that because, I mean, our directors are here. Free trade zone, yes, remain, but what is significant is the fact that now, any sale that you sell to the custom territory, which means if you're in a free trade zone, and then, let me use Dangote as an example, even though there's a special provision in the law that if you read very well, it looks like it's speaking to Dangote because of the peculiar situation that we find ourselves. But if you remove that, if you sell refined oil to be consumed in Nigeria here without selling it to Ghana or export, the law says that you pay tax on it. For now and next year, if it is no more than 25% of your turnover, if you sell more than 25% of your turnover, the excess you sell in Nigeria, which we call the custom territory, will be liable to tax. Okay, so free trade zone, a lot of things have been changed. All of those old government order that was issued that now give them the right to be selling the way they like. In fact, there are some free trade zone that are springing up even near my offices here. Suddenly, the next office to me is free trade zone. So why wouldn't I also be a free trade zone? Okay, so that provision has been recalibrated and a lot of things are happening. The last point here is the issue around business restructuring. Okay, this is very good because if two companies merge, okay, the law has now allowed that the loss that one is carrying can be carried by the new or surviving entity. If one of the entity has credit notes with tax authority that have not been utilized, as long as it is pure merger, the surviving or the continuing entity can now ask to use the credit note. A lot of good things around business restructuring. You can take a look at that. Rounding up, 6 dimensions of economic transformation, revenue optimization, yes, investment climate change, fiscal transparency is what is, all of this is centered around international credibility so that our tax law will align with other entities, other countries, the Pillar 2 metric, minimum effective tax rate, the CFC rule. You can see in line 2 there, the first point, international credibility. I have put the CFC rule. The CFC rule is such that if you have a subsidiary that is in a tax haven, a lot of companies have subsidiary in tax haven, in Cayman Island, in Mauritius, where their tax rate is either 0 or near to nothing. Okay, so the rule now is that if you have subsidiary in those territory, that the income can even be deemed to have been made in Nigeria and not those, but you have just found a way to incorporate such company to hide such income. The law says that such income must be distributed as dividend to the Nigerian holding company. And where the company failed to distribute such income, it will be deemed by the tax authority as if the company has distributed, and it will be added to the Nigerian holding company of that subsidiary. Some details there, which you can take a look later. Energy transition signal, the fossil fuel. Yeah, let's not talk about that too much and all that. So managing the transition from old to new, prior action protected. There are provisions, what we call the savings provision in Section 198 that says that the old, whatever is happening before will still continue to happen as long, for example, if you have a pioneer status that has not expired, you are allowed to utilize your pioneer relief until it expires, as long as you have started it. So even if it is 31st December 2025 that you are given, you can still enjoy your pioneer provision. All those savings provisions are in the law, including all the subsidiary legislation, the executive order, the regulation, blah, 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 the transfer pricing regulation. All of those are still well protected. Rounding up, again, what do we need to do quickly? As ensure that you carry out or conduct a comprehensive tax health check. Check how this new law has affected you, how you are going to transit from the old law to this new law, and make sure that everything is well tidied up. Okay, upgrade your technology and digital infrastructure, particularly for a bank that now have so much responsibility as a compulsory agent of government. You know, they make you to help them collect, and they don't pay you, and when you fail, they charge you. Meanwhile, you even have to invest to be able to carry out all of this obligation, which has become very compulsory. Okay, so you may need to do some upgrade along the line. Digital infrastructure should be brought in. If it's not in place, some of these NRS are already doing that, changing a lot of their provision. Again, be careful, watch out for transfer pricing, think capitalization, and also the CFC rule. And then evaluate incentive eligibility strategically before you jump into any taking advantage. Restructure your compensation structure and payroll. There's no hiding place. People have been asking me, so how do we structure our payroll now? Do we pay some off the payroll? Anywhere you pay it, as long as it's going to somebody's pocket, it's an income, and you may have to pay the tax. Okay, so you need to avoid having to be taxed on penalty and interest for failure to pay and all that. And again, please, not all the consultants are that expensive. A lot of them can be, I have mentioned Crescent Pedabo. There are other firms that you can use, okay, to support you, to support the organization, and then to reduce the burden. It is really a lot of burden for businesses as we speak. So what to watch out for in 2026 and beyond? NRS establishments, this is the last slide, and operationalization. They are doing a lot of things to change from their FRS to NRS, including their technology, their organization structure. They now have executive director instead of this and that. They can call themselves anything. You don't really care about that much, Abi. Yeah. Okay, then the presidential order, we are hoping that a presidential order will come up that will reduce this 30% to 25%. I mean, our corporate tax rate is high. In addition to 4% as a development levy, it is excessive. Okay, so it's part of the prayer that this thing will come down. The fiscalization system deployment, like I mentioned, is critical. We need to be careful. We are hoping that they can let us settle down before this positive fuel surcharge will commence. NRS regulation and guidelines. We're expecting guidelines as to some of the provisions in the law cannot be implemented without guideline or regulation. Thank God our chairman now, who is now the Minister of State for Finance, is in a place where he should be able to sign those regulations. I expect to see a lot of action. Tax Ombudsman have said a lot about that. Thank you very much for this time that you have given me. If there's opportunity, we'll take questions. Thank you, sir.
Thank you very much, Mr. Albert Florishaw.
Thank you.
We didn't stop you because it was very exciting and very illuminating, and some of them were like hammer, and that's why we instead of 25 minutes, we took close to 1 hour. But I'm sure, yes, close to 1 hour. I started at 15:12, and now this is just about 7 minutes back. But it was very enjoyable. So thank you again. We are glad that you were part of this, because that was the intention of this webinar. First, to look at how the new tax law affects the common man on the street, his businesses and companies, but more importantly, what the government had in mind in coming up with this new tax law. And I must say that you have gone to a reasonable extent to expose the government's position and how deep government has gone. I don't want to go into the analyzing your paper and that of Dr. Iberechi. We have a panelist that will do that, and I'm sure that as your presentation was going on, they were taking down notes. So I want to very, very quickly introduce our panelists that will go through and make comments on the papers presented, and after that, we'll now have some time for question and answer that we treat. I also want to encourage attendees to put their questions through the chat room. We'll pick those questions and relate it and ask them for both the panelists and the speakers to probably address. So very quickly, our panelists, we have three strong-minded panelists, and we have also tried to be very inclusive in that. So we have first Ms. Taribaba Member. The Taribaba Member is the vice chairman of the Nigerian Association of Chambers of Commerce, Industry, Mines, and Agriculture. She also serves on the board of trustees of the Nigerian Association of Travel Agents, and is an active member of the Nigerian British Chamber of Commerce, as well as the Nigerian American Chamber of Commerce, including the Port Harcourt Chamber of Commerce, Industry, Mines, and Commerce. I'm sure that, and Agriculture, sorry. I'm sure this tax law impacts them, and that's why we have her here to speak from the impacted party point of view. So welcome, Madam Ms. Taribaba Member. Also on our panelist is Elder Vincent Okoku. Elder Vincent Okoku is the chairman of the Manufacturers Association of Nigeria, the Rivers and Bayelsa chapter. Of course, no other sector is heavily impacted with these taxes more than the Manufacturers Association of Nigeria, who have been shouting to high heavens on the need to reduce the tax burden. And like we have been saying and what you are hearing, when I hear that the company tax is still 30%, well, I'll leave that to the man people to talk about the impact. And finally, on our panelists is Mr. Gbenga Alaba. Mr. Gbenga Alaba is a tax practitioner and a consultant. He's the managing consultant and partner at Unilat Consulting and Gbenga Omoniyi and Co. Firms of chartered accountants and tax practitioners based in Port Harcourt. He's also a tax fraud expert registered with Association of Certified Fraud Examiners, as well as the Chartered Institute of Taxation of Nigeria. So those are our panelists, and over the next 22 minutes, they will be dissecting and making comments as it concerns each of their sectors on this Nigerian tax law. First, let me invite Elder Vincent Okoku to share his thoughts and comments as this tax law affects the manufacturers in Nigeria. Elder Vincent Okoku, please.
Thank you very much. I hope you are hearing me.
We are hearing you loud and clear, sir.
Hope I'm heard, right?
We are hearing you loud and clear, sir. We're hearing you. Go ahead,
All
sir.
right. Thank you very much. First of all, stand on the existing protocol. I thank the presenters. They are able to present the tax law as how it should be implemented. I know the summary about it is that while this increases government revenue, it also reduces disposable income for many households. I will speak how it affects the manufacturers. Basically, for us, the new tax law regime is good in the sense that it tries to streamline or make it clear what you are supposed to do as a manufacturer. But where we are worried is, like, for example, the cost of input. The new tax law, for example, the 7% VAT, it makes the input for a manufacturer higher than what it used to be. Outside that, the issue of multiple taxation, if it has harmonized completely taxes so that once you pay this, the state government, the local government, and the federal government share from whatever is collected, would have been better. But now, the lacuna now is that even the states will still come up with their own. The local government will come up with their own tax. And this multiple taxation makes our production, the cost of our production, not competitive compared with other manufacturers. So, but we see the tax law as work in progress. We are quite convinced that with time, from what we saw the presenters, even themselves have presented, is that with time, government will still work to improve so that the manufacturers who has lot of input to produce and make us competitive in the global economy will be able to produce and sell. For example, in the African Trade Union Congress, we now have an agreement whereby things produced in Nigeria can be sold in Egypt with less bottlenecks. But these bottlenecks have not been removed up to now because every country is trying to protect their own industry. For manufacturers, we have so many other taxes that are not that are already existing, that are not tampered with the new tax law. So we are hopeful that with time, government will look into it. One of the major cause of our cost of production, the energy infrastructure in Nigeria is still very poor. If government can, from the proceeds of this new tax law, invest on infrastructure so that we have good roads, the cost of energy come down. Because when you add VAT plus fuel subsidy, automatically all the benefits that is part of the why we have hyperinflation. But we are optimistic that with time, the government will harmonize this tax law in such a way that both the manufacturers and the government will benefit. Thank you.
Thank you very much, Elder Okuku, for your comments. We agree that tax laws are good because it's beginning to streamline some of the taxes that manufacturers were exposed to, even though you also hope that government will use the increased revenue to work on infrastructure and further reduce the cost of manufacturing. I'm sure the speakers are taking notes and be able to address all those issues. Let me invite the lady in our midst, Ms. Taribaba member, to make her comments on the implications of this new Nigerian tax law. Over the next 5 minutes.
Wow, wow, wow. So many things to assimilate on the new tax law. We have a whole lot to learn as concerns the new Nigerian tax laws. Wow. I'm sure everyone will agree with me. This session is
put on your
so
video,
timely.
madam, so that we can see you.
Yes, I put it on. My video is okay. Let me see. Yeah. Okay. Yeah, my video is on now.
Okay.
But I don't know what's happening. Can you see me?
It's still waiting for visa processing on the lines. But go ahead, please.
Okay, now I was saying that you all agree with me that this session is timely. It's been very enlightening and educative, especially for the business owners. Like for the travel agency, the MD of Now Travel and Tours. Yes, so it cuts across everybody. And something that is intriguing, I want to find out what are the basic elements of an employee. Dr. Henry said something about the salaries and how it affects the common man and the business community. So, Dr. Henry, are you still there? I just want to find out how it affects us, the taxable elements of an employee on our payrolls. Can you just, I know we didn't talk on that in depth.
Okay.
Is Dr. Henry there? Or maybe
yes,
Mr. Albert can just help.
They are going to comment on it. They are taking down notes so that they will take all the questions, clarifications at the same time. Okay, thank you very much. Is that all you have?
No, that's not all.
Okay.
I want to say that the tax laws are very, very, they favor, that's what I wanted to say. They favor the common man, the people that earn less. And so I was just thinking, are we encouraged not to earn more so that we don't pay more in tax? Because I was just looking at it because we're talking about the poor, how they tax. More, if you earn less, you pay less tax. And when you earn more, you pay more tax. So it's really encouraging for the small businesses, for people that are in small scale businesses. Yeah. And for all of us, the tax laws are really favorable because the more you earn, the more you pay your tax. And for the taxes, this is something that will encourage Nigerians. The new tax law, as against the old tax laws, there are a lot of favorable terms for us in businesses. So something else I caught was we are now more on the global tax law practices. The more you earn, the more you pay. So on our daily business lives, it helps us. Very, very enlightening. And there was something that Mr. Albert said that I took cognizance of. There are a lot of exemptions from tax, like the health. We have health that are exempted from tax, and education and VAT on food. So those are laudable that the tax elements favors all those businesses. And he also mentioned that we should upgrade technology. We should embrace it. The new tax is here to stay. And for us, change is inevitable. There are lots of new ways and new forms, this new tax laws, and run with it. Thank you.
Thank you very much, Madam Member. That was very, very, very good. You noted that the new tax law is timely and appears to be very beneficial to businesses and has something for each one. Of course, you're concerned about salaries and how it's going to affect salary owners. I'm sure one of the speakers will be speaking to that. Well, I'm sure the issue of the tax law trying to make us to be low-income earners is said in a lighter mood, because I'm told in school that the higher you go, the cooler it becomes. So as you earn more money and you pay more tax, you still have a lot of leftover to enjoy. So I'm sure nobody will want to be a low-income earner. Anyway, thank you again for your comments. Your questions will be addressed by the time we get to it. Well, let me now invite Mr. Gbenga Alaba, who is a chartered accountant and a tax consultant, to share his thoughts on the new tax law and how it affects the professionals.
All right, sir. Thank you so much.
Over the next 5 minutes, sir.
I will really commend all the speakers that have spoken before now, starting from the chairman of the Chartered Institute of Directors, Otuba himself. In his opening remark, was able to put us through the merits and the entire perspective of the tax laws, the new tax laws in Nigeria. And of course, Dr. Henry also talked about the misconception and wrong perception of the new tax law, which of course has been what we as tax consultants in all the 36 states of the country and the FCT have been going around. Before now, since last year, we have been sensitizing all taxpayers, individuals, companies, and the like, how they don't need to believe what has been said or is going on in the social media about the new tax law to discredit the current administration. He mentioned several of the misconceptions, which among he said, your bank balance or bank savings is not taxable. He mentioned that pension that they earn on a monthly basis, of course, is not taxable, compared to what people are saying everywhere, that even if you borrow money from the bank, the government will tax you on the borrowed money. So all those misconceptions, the fears has been allayed by Dr. Henry himself. And Mr. Albert Folonshaw went further And I was even wondering how he was able to go through all the aspects, relevant aspects of the tax laws within 1 hour or the less. He was able to tell us about the various tax that we have in their section, the transaction taxes, the VAT, the withholding tax, stamp duties. He talked about the petroleum related taxes, the hydrocarbon tax, petroleum profit tax, the 5% foreign electric surcharge, which is still suspended. And he talks about the company-based taxes, the company income tax, the payee, the development levy, or in the new tax law. And of course, he talked about the 4 tax laws that were passed by the National Assembly, accepted by the president last year: the Nigerian Tax Act, the Nigerian Tax Administration Tax 2025, Nigerian Revenue Service Act, and the Joint Revenue Tax Establishment Act. And talk about the issue of the minimum effective tax rate, that when you're a big multinational companies, now it has been noticed that the taxes you are paid is below the effective interest rate of 15%, that you'll be asked to pay the difference. Of course, he went further to talk about the thin capitalization, where directors of companies and as well as related companies borrowed loan to a firm, and they charge interest at whatever rate they deem fit to charge, and thus reducing the profit that will be subjected to tax. That the new tax law has now brought it to an agreed level that 30% of whatever amount you are paying as tax, as interest on the loan, should not be more than 30% of the EBITDA. And once it is more than that, it will be added back and disallowed by the tax authority, which you pay tax on. Then you talk about the payee tax bracket, which is being progressive. The more you earn, the more you pay. Then talk about the free trade zone. Companies operating the free trade zone, how you'll be exempted from paying taxes of whatever, except where what they are selling within custom jurisdiction in Nigeria is about 25%, then they will pay based on that. Then talked about the stamp duties, the capital gain tax, and the withholding tax. Then he also went ahead to talk about the wins in the new tax law, the challenges in the new tax law, and of course, the intention and the objective of the new tax law, which among others he mentioned to align with the intent of the tax practice, international tax practice, fiscal transparency, because many people are really not believing the present administration. They're looking at it that will it be an avenue to extort the masses. Of course, the government has promised us for fiscal transparency, that whatever money that is earned needs to be disclosed, and that is what they do. Everybody optimization, because government activities are increasing on daily basis, more revenue are required, and of course, that is why the taxes is progressive. The more you earn, the more taxes you're expected to pay. Then he went ahead to talk about the 6 strategy steps to navigate the new tax law. All those things are what we have been going around to sensitize and educate different taxpayers across all layers, across the 36 states of the Federation. And we are sensitizing them to make them know that this new tax law is something that everybody needs to embrace and ensure that they comply with, because it's going to be a win-win thing, and it's going to take Nigeria from the current level we're operating to another higher level, because Nigeria, among community of nations, is not a small country. And for us to achieve our strategic goal as a country, we must ensure that everyone contributes to the national pool, providing more revenue so that government can use it for the development of the nation. Now, before I will draw my mic, there is one other aspect of the tax which I would like to really call attention of everyone into. In the new tax law, there is something which they also refer to as presumptive tax regime, a prescriptive income tax assessment of 1% of annual turnover. And what is it all about? That we have different categories of persons that are earning income in Nigeria. We have those category of people that we refer to as small-scale traders or businessmen, artisans, people like mechanic, plumber, and the rest like that. How are they supposed to pay their taxes? Because the tax net wants to cover everybody. That if truly you're a true citizen of Nigeria, you have a tax obligation to meet. So because of that, this presumptive tax regime of 1% is also in the tax law. That once your taxing, if you are not keeping your proper record, because that's what the tax regime is actually about, the presumptive tax regime. If you are not able to keep proper book of accounts, then how are we able to determine your tax? So the tax law mentioned that we'll be able to assemble, to assess you based on what you do, your business premises and your turnover. And once able to establish, the tax authority is able to establish that your annual turnover exceeds 12 million naira. Then 1% of such amount will need to be remitted to government as your tax, which you have paid for the year. And of course, government also encourage individuals or small businesses in that category, which has not been keeping their proper record, to try to keep their record so that they can escape from that 1% charge of all what they have earned in the year. Because if you're able to keep your proper record, and of course, your total revenue is not up to 100 million naira as a small company, you have no tax at all to pay. But when you do not keep your proper books of accounts, then it's now obligated on your part to pay 1% presumptive tax on all what you have earned, based on best of judgment by the tax authority. It is important that we should also include that so that we can know that the tax payment, nobody is to be excluded. Insofar you earn income in Nigeria and you benefit from some of the services, essential services that government is to be providing, then you're expected to pay your taxes. So thank you, moderator. Thank you, the speakers that have spoken, and also co-panelists. Thank you for the time.
Thank you very much, Mr. Alaba. You have eventually summarized the papers of Mr. Albert, but at least you added the presumptive tax regime of 1% of annual turnover for artisans and small businessmen. Thank you so much. I thought I would come back to the panelists, but I believe they have made their comments. Let me quickly revert to the speakers. I want to invite Dr. Eberechi to just quickly go to his slides on that salaries that Ms. Member wanted clarifications on, how the salaries will be, how it impacts salary workers. Dr. Eberechi, if you, in 2 minutes, you can just pick up your slide to that points that speaks to that and clarify this member.
Okay, thank you so very much. Thank you, I appreciate. Well, like I said earlier, this is not what we can do in 2 seconds or in 2 minutes. It's something that for better clarification, you need an accountant in your office to help you out. But nevertheless, I will just give a summary within this 2 minutes that you give to me. Let me use figurative values right now. Let me say, for instance, you are earning 6 million naira annually. By the time you use the old tax law to compute, you'll be removing the consolidated revenue, the revenue funds, remove that, remove so many other deductions. At the end of the day, what you'll be paying is going to be 896,000 naira annually. Then by the time you prorate it for the month, you divide it by 12. That's what you'll now be paying with the old law or tax act. But with the current one, by the time you apply the 18% at the end of the deductions, what you will be paying will be about 780,000 naira. So you'll be saving 116,000 naira. This is not actually stated in the slide, so I'm trying to explain it, figuratively, to put it in the perspective where people will understand much more better. So apparently, you'll be saving 116,000 naira, which is a lot of money for you to use to do other things. And that's why we're talking about disposable income. With that, now you can use to spend in other areas of needs. I also mentioned about the issue of saving and having more disposable income, because someone said it's reduction of disposable income. No, it's increasing your disposable income, not reduction. Because with the new tax law, you're going to have more money in your hands. And the more money you have, it is disposable income you now have to spend in other things. How are you going to have this? Because there will be VAT reductions or VAT, exemptions from things like the food, the healthcare, education, baby products, sanitary towels, transportation. So you now have more money in your hands to spend. That is your disposable income and not reducing the disposable income.
Okay.
So I think that should take care of that. Now for the income
The
aspect,
next-
like I said, you have more money in your hands.
20 or 30 minutes.
Pardon? Somebody will say something, please.
Please conclude. Go ahead.
Oh, okay, yeah, yes. So that's basically what it is. I'm sure by this, the question has been thrown to me, has been fully answered.
Thank you very much. Thank you very much, Dr. Iberechi. There are some questions that were posted on the platform. I'll just go through them, and I'm sure Mr. Albert Florence Shaw will be able to quickly clarify them in about 5 minutes. One, somebody wanted to know, say, does a business name with a turnover less than 25 million pay or do not pay withholding tax? But I think the threshold is now 100 million. Maybe Mr. Albert will clarify. Secondly, does a company with less than 100 million be charged withholding tax if they transact with other companies, and should they still pay VAT for their invoices? That's the second question. The third one is, are there details on prevention of double taxation for Nigerians abroad that earn salaries abroad, where those salaries are taxed at source? And of course, I also want Mr. Albert to speak to Elder Okoku's comments as to bottlenecks that still exist in international trade, particularly as it affects trade within Africa. And finally, is, of course, I also want him to provide clarification on this presumptive tax regime of 1% that Mr. Alaba alluded to. Is it correct, or it has also been subsumed in one of the 11 tax laws that have been repealed? And finally, it's from the presentation of Mr. Albert, it appears is preparing the ground for VAT to go up to 15% when Nigerians are crying that the VAT has implications for increased costs, particularly when he mentioned the pass-through price effects of some of the so-called reliefs that have been given, and that companies are going to suffer. They will still pass it to the final consumer. And then he was preparing, I noted that very well, laying the solid ground for making tax VAT to go up to 15%. And finally is, why is the withholding tax for individuals now treated as final tax? Is it more beneficial to treat a final tax, or to treat it as an advanced tax, where the individual can still claim that in reducing his tax liability? Over the next, I don't know if you can do it in 5 minutes. You have done a lot, but you're a magician. I'm sure you can do it.
Thank you very much. I don't know which one to start first. Okay, let me start with the VAT increase story. You know, when the law was being made, for you to suddenly allow all deductions of input VAT on both, you know, let's say you are manufacturing biscuits, you buy raw material to do the biscuits, you have machine that you are using to produce the biscuits, you incur expenses that you are using to produce the biscuit. Under the old regime, you are allowed to only take deduction for the raw material to do the biscuit, while the one for your overhead, you expense it, the one for your asset, you capitalize it. But we are saying that is not really VAT. That is a sales tax that is very common in the US. It's not the VAT, which is an input-output mechanism where the taxes devolves in successive stages so that at the end of the day, it is the final consumer that bears the burden. So in this case, what has been done now is to implement a proper VAT, which means you are eligible to take deduction. So if you are eligible to take all these deduction, what goes to government in terms of what you pay to government has been, I mean, it's near nothing. And so when the platform was presented, the idea was to reduce corporate tax to about even 18% instead of this 30% we're talking about, so that slightly VAT can go up and accommodate, this deduction. The push was to allow all these deduction. If it is VAT, you should allow all deductions. Okay, so the Governors Forum approved that, yes, allow all deductions, but will not allow you to reduce corporate tax so that we can still get money at the end of the day. Okay, so I'm not preparing grant for increase. I also pay VAT, but I'm just saying that in practical reality, we will see that it is impossible to take those deductions out of 7.5% and still have any balance. In fact, government is going to be doing refund for the next few years. And I'm sure Nigerians are happy with it. Okay, I'm just giving you the practical implication. I'm not begging government to increase. Don't allow labor to come and look for me. In fact, they should reduce it to 5%.
Okay, now you're talking. Now you're talking.
Let us reduce VAT to 5%. For me, if I have my way, I'll reduce VAT to 5%. And let's just pay it 5% and not any deduction. Yes. In fact, that's what I'm going to sing now.
Okay, go ahead.
All right. Number 2, withholding tax as final tax. Yes, withholding tax as final tax is beneficial than taking it as credit. What it means is that, our corporate tax rate now is 30%. Even individual, depending on your level, the least rate you can have is 15%. So if you say an income has suffered withholding tax, which can be as low as 2%, as low as 5%, as low as 10% for dividend and interest, and you are saying, as soon as you have paid this 10%, don't pay any other tax. It means that when you are doing your computation at the end of the day, where you are going to apply your 30% or your personal income tax rate, this income will be taken out. You will say, this income, I have paid tax on it. Don't tax it again. Don't bring 30% on top of it, which means your 5% that you paid upfront is final. That is what everybody wants. Okay, it's more beneficial. That increase, prevention of double taxation. Yes, there are provisions in the law to take care of double taxation. We call it elimination of double taxation agreement. Nigeria has agreement with about 15 countries now. And in Article 22 of most of them, particularly the one with UK that was signed in 1989, sorry, 86 or 89, thereabout, there is elimination of double tax. And it's just that a lot of people don't pay attention to treaty provisions, but there are provisions. So if you talk about Nigerians working in abroad and pays, the fact that they have paid tax on their salary here does not mean that it's taxable in Nigeria. Okay, even though we talk about determination of domicile and all that, it doesn't mean that because you are a Nigerian living in UK, the income you earn in UK will now be taxed in Nigeria. On what basis? You are not resident in Nigeria. The fact that your origin is Nigeria does not make you a taxable person. It is only if you have a taxable source in Nigeria, then that source will be subjected to tax in Nigeria. Okay? And then most of the other questions that you talk about, I've answered them. The issue around withholding tax on 100 million and all that, I answered them directly, and I'm sure they have seen the answer. The last one I will speak to is the presumptive tax. Yes, there is a presumptive tax provision in the law. It is essentially for individuals and enterprises. Like I mentioned, answer to somebody on the platform, enterprises are not taxable. You pay tax in the name of the owner of the enterprise. Even as a firm of chartered accountant, you don't pay tax in the name of the firm. You pay tax in the name of the individual partners. So if you're a sole trader Ojo Enterprises, Ajayi and Co., James, it is you who owns the business that will be subjected to tax. So this presumptive tax is applicable where government is sure this person's lifestyle and way of life shows that he has income which has not been declared either under the personal income tax declaration by 31st March. By end of this month now, every individual should file their return saying so much is the income I generated in 2025 and asking the tax authority to raise assessment. Lagos State, I'm preparing my own as well. Okay, so if you fail to do that, or you fail to prepare records so that government will not know how much you have, they can use this presumptive tax. Again, this presumptive tax that has been made in the law is just a framework. Individuals are taxable in their state, and states now have the obligation to harmonize. So part of what is being done by GRB, Joint Revenue Board, is to encourage the state, individual state, that, okay, this state have done this, you too copy it, let it be similar. You know, it's part of their responsibility to ensure uniformity in the application of tax law throughout Nigeria. So if Lagos State is saying, if your own, somebody also asks, the 100 million, does it apply to individual? It does not apply to individual, it's applicable to company. So each state is determining what they think should be the threshold for individual that will be exempt. Some of the states have adopted 12 million, which means if your income in a whole year is 12 million and below, they don't pay tax. Okay, but if it is more than that, then they will apply specific rate as a deemed fit. They are also looking at different type of businesses that should be left regardless of what they are doing. If you are frying akara by the roadside, or it is plantain that they fry it, okay, or whatever, you are only doing wheelbarrow and all that. So they are taking exemption out. All those are the domestication or the harmonization of the law that we are talking about. Presumptive tax is for those who can truly pay, fail to pay. Government have details of them. They will raise it as the best of judgment. I hope that's...
Thank you very much, Mr. Florencio Albert.
Thank you so much.
You have clarified a lot of things, and thank you for coming. I'm sure you have clarified all the issues. On this note, I want to hand over to the DG CEO of the Institute for the vote of
sorry, sir.
Closing ceremonies.
Sorry, sir.
Yes, sir.
I think you can handle it. The DG had an emergency, so he had to step out. I actually sent the message to you, sir.
Okay. I saw your call and I was trying to find out what you were trying to say. Okay. Okay. So it's a big task. So I'm trying to readjust myself. Thanking big men is not easy. So again, let me thank our speakers. First of all, let me begin by thanking the president and chairman of the governing council of our great institute for making time to be part of this webinar. The attendance has been so much. At a point, I noted about 161 people in attendance. And that speaks to the example that our president has been leading and the changes to be bringing to bear in our great institute. So thank you so much, President and Chairman of Governing Council, for taking time to be with us. We appreciate it. Of course, our speaker, Dr. Henry Eberechi, we appreciate you. It's instructive to know that the notice was short, but you've done justice to the presentation that we gave to you. Our guest speaker, we can't thank you enough. It was also, in fact, your own notice was even shorter. And the fact that you came on a representative basis and did great justice to the paper. I was monitoring the comments on the site. When you were saying, do I have time? People were saying, please give him time. It's a great presentation. So thank you so much. We appreciate you. You've done justice. You have clarified a number of issues and helped to allay fears that both the small businesses and individuals were entertained. I'm sure participants are better informed and you have made disciples of those who will go out there in the field to defend you. When people from Man and Nasima are speaking so glowingly of you, then you have done a good job. Please tell your boss from we to you that you've done a very good job. To our panelists, thank you. You've started all through it. You have made your comments, your observations have been very, very incisive and very, very insightful. Particularly Mr. Laba, who brought to fore the issue of the 1% presumptive tax that was blindsided. To the chairman of the Port Harcourt Zone, Kufre Abasi Obao, you are the one that has made this webinar possible. We appreciate you. Not only that you made it possible, you have sat all through it with your executives, the vice, the secretary. I saw the treasurer's comments, Pastor Ajibade. She sat all through it. All the executives, we appreciate you. Members of the committee, the programs committee, that have also sat through all this, and the secretariat, Patrick and your team. You've been very, very good in making sure that this thing is the successful outcome that we have seen. We want to appreciate all members, all directors that made time to be part of this webinar, which touches all of us. You know, tax is an issue. Once you talk about tax, you know you can't run away from it. You don't offer tax, you pay tax. So it's an obligation that we all owe. I'm not surprised that we had over 160 people sitting through this session to want to know more of the Nigerian tax law, and I'm sure everyone has gone back satisfied. Of course, finally, I want to thank God Almighty, who gave us life and gave us the strength and wisdom to come together to share the things that we have shared. We can't thank him less. Thank you, everyone. And I want to hope that when next we invite you, please, let's see a better turnout. I will not close the session without going back to the chairman of Port Harcourt Zone and Southeast Zone, acting chairman, Mr. Kufre Abasi Ubahu, to please do the closing, have a closing word. Thank you.
Yeah, good evening again, all directors, and especially our special guests, the panelists. Indeed, it has been a really great, engaging time. I personally, I think I have learned a lot of things from the presentation so far, and I believe a lot of us seated on this other side, listening to your presentation, your answers to questions. It's been a great one. On behalf of the Institute, we want to say thank you. And we'll believe that this is just the beginning of the best days. We will still have to engage you again, because it's just the tax is a new policy that is coming up. We believe as time goes on, we will still have you all put again to come and clarify to us the new challenges that was not foreseen in the beginning that might actually comfort. So once on behalf of the ESCO, the president of council, I want to say thank you. And also the committee, also, I think we say thank you. It's been a good outing, and we give God all the glory. So as we celebrate the holiday tomorrow, we believe that it's going to be well for our nation, and also it's going to be good for all of us individuals. Once again, thank you, and God bless you.
Thank you, sirs. Have a wonderful evening. God bless you.
All right. Thank you, everyone. Madam,
Thank you,
done.
Elder, thank you.
Thank you, sirs. Mr. Albert, we appreciate. Everyone, we appreciate. Elder Vincent, we appreciate. Thank you so much. God bless you.